Tell your family movie night is canceled. Mom or dad needs to sit in front of a blank screen and breathe into a paper bag for the next 48 hours. Because while you were asleep, while you were thinking about football or brunch plans, the financial infrastructure of the Western world didn't crash. It flickered. And in high-frequency trading, a flicker is worse than an explosion. An explosion is obvious. A flicker makes you question reality. Ladies and gentlemen, it's Saturday, January 31st, 2026. Markets are closed. Trading floors are empty. This is usually the quiet time. The plumbing phase of finance. This is when clearing houses reconcile the books, settle trades, and publish reports that tell us who owns what. Boring. Routine. Mechanical. Except today, the plumbing is leaking radioactive waste. For days, we've been monitoring data feeds from CME Group, the Chicago Mercantile Exchange, the most important derivatives exchange on Earth. And something is wrong. Very wrong. Key reports are missing. Daily delivery notices. Issues and stops data. The fingerprints of physical gold movement. Instead of numbers, we're getting zeros. Stale timestamps. Silence. This just happens to coincide with the most violent week in gold market history. Do you believe in coincidences? Because I don't. I believe in crime. To understand why this matters, you need to understand what's missing. Every day, the CME publishes two critical numbers. First, volume. How many contracts were traded? Second, issues and stops. How many of those contracts demanded physical delivery? If 100 contracts stand for delivery, 100 notices must be issued. The math must balance. But for weeks, it hasn't. We're seeing massive trading volume with delivery numbers that make no mathematical sense. And today, the report didn't update at all. The CME released a vague statement blaming technical issues. That's corporate code for we've lost control of the ledger. This isn't a video game server. This isn't a streaming glitch. The CME is the central nervous system of the global economy. It spends billions on redundancy, backups, and cybersecurity. It does not glitch during a multi-million-ounce delivery cycle. That's like the vault door at Fort Knox falling open on the same day a convoy rolls by. This isn't an accident. It's a cover-up. And to understand what's being covered up, you have to look at the shadows. At the rumors circulating in intelligence circles. A name keeps coming up. Salt Typhoon. Not a storm. A code name. An alleged state-sponsored hacking group tied to China, reportedly embedded deep inside U.S. critical infrastructure. And if even part of that is true, then what we're watching right now isn't a reporting delay. It's the digital footprint of the largest financial heist in history. They talked about telecom networks. They talked about power grids. But nobody talked about the one layer that actually matters. The financial settlement layer. Here's the theory that's starting to leak out of dark web forums and private risk channels. What if Salt Typhoon didn't hack the CME to destroy it? What if they hacked it to front-run it? Imagine you're a state-level hacker working for a government that desperately needs physical gold. You don't blow up the exchange. You use it. You slip into the matching engine. You insert a ghost protocol. A line of code that quietly prioritizes your orders ahead of everyone else's. You stand for delivery. Over and over again. You drain the registered vaults, move the metal into your accounts, and suppress the reporting so no one sees the outflow in real time. You steal the gold while the security cameras loop footage of a full vault. That explains the glitch. The reason the CME can't publish the report isn't because the system is down. It's because the numbers don't reconcile. The computer thinks there should be 50 tons of gold in the vault. Reality says 0. The algorithm crashes because the database and the physical world has separated. They can't publish that report. Because the moment they do, They admit the vault is empty. So they pull the plug. They declare technical issues. They buy themselves 48 hours. The weekend window. Time to find metal. Time to rewrite ledgers. Time to beg the Federal Reserve for a backstop. They're patching the hull while the ship is already taking on water. And here's the tell. The market can smell it. Smart money knows one rule. You don't hide data when business is good. You hide data when liquidity is gone. If this were just a reporting error, arbitrage would still be working. The bots don't need daily settlement reports. They live on millisecond feeds. But those bots are broken too. The spread between New York gold and Mumbai gold has exploded. $283. That's not a spread. That's a canyon. That's the market screaming that the bridge between paper gold and physical gold has snapped. New York is trading paper. Asia is demanding metal. And there is nothing left in the middle. If you think this is incompetence, if you think someone spilled coffee on a server rack, you're living in a pre-2026 world. Because for 3 months, cybersecurity analysts have been warning about salt typhoon. They found them in water systems, in broadband networks, in the power grid. The media called it prepositioning, logic bombs, lights out scenarios. But they missed the real target, the settlement layer, the plumbing that decides who owns what. Here's the question Wall Street risk desks are asking this weekend. What if the CME glitch isn't a bug? What if it's a feature? What if this wasn't sabotage? What if it was the most sophisticated bank heist ever executed? Because in the 21st century, you don't rob a vault with guns. You rewrite the rules that decide who the vault belongs to. You don't run in with masks and guns. That's amateur hour. In the 21st century, you hack the ledger. You infiltrate the matching engine, the algorithm that decides who owns which contract, and you insert a ghost protocol. The rumor circulating in closed forums is this. The hackers didn't shut the system down. They bin it. They allegedly manipulated the delivery notice logic itself. A backdoor that allowed valid delivery demands for physical gold to be issued, while simultaneously suppressing those demands from the risk and reporting systems. In simple terms, they told the vault to release the gold, while telling the cameras nothing was happening. The system was blinded. For nearly 2 weeks, data irregularities were dismissed as noise, while bullion may have been quietly reclassified out of registered inventory and titled into shadow account controlled by shell entities linked to the East. The pool was being drained. The gauge still read full. That explains why the CME went dark today. This wasn't a spreadsheet error. They likely ran a physical audit and discovered the map didn't match the territory. The computer said 5 million ounces. The shelves were empty. Technical issues is the cover story. Because if they publish the real numbers, if they admit to a sudden unexplained collapse in eligible inventory, it triggers an immediate global run. So they pulled the plug. They shut off the scoreboard to hide the score. And the obvious question is why? Why would China risk something this aggressive? Because this is war. If the United States is pursuing a Plaza Accord style strategy to weaken the dollar and suffocate the Chinese economy, then China needs an asymmetric response. Draining comics is that response. You don't attack the currency directly. You steal the collateral underneath it. You force a default. You expose that the system is running on promises instead of metal. It's a raid in the oldest sense of the word. They came at night, while the guards were asleep, and they took the treasure. This reframes everything. That $283 spread isn't a market inefficiency. It's the market pricing in the theft. Smart money understands what that gap means. Registered inventory is fiction. Paper contracts in New York are now claims on an empty vault. The cyber war has crossed the line. It's no longer about stealing data. It's about stealing atoms. And if this theory holds, if the settlement layer has truly been compromised, then Monday morning isn't a volatility event. It's a crime scene. The CME faces two options. Admit the data is corrupted, destroying trust. Or admit the metal is missing, destroying price. There is no third door. They can suppress reports. They cannot suppress math. Because while they were fighting hackers, the arbitrage systems noticed the break. And that brings us back to the number that matters. $283. Math doesn't care about press releases. It doesn't care about technical difficulties. Math only cares about equality. And right now, the equation that holds the global financial system together has returned a divide by zero error. A $283 anomaly that should not exist. Let's look at the scoreboard as of this Saturday night. Markets may be closed, but the damage is already visible. The networks are still quoting prices. And the divergence is getting wider by the hour. In New York, the paper price of gold, futures contracts that supposedly represent metal, is trading around $5,200. In Mumbai, the physical price, the price to actually hold a kilo bar in your hands, is trading at $5,483. That's a $283 gap. Now you need to understand how a normal market works to grasp how dangerous that number is. In a functioning market, high-frequency trading firms eliminate price differences instantly. These companies spend millions laying fiber optic cables under oceans just to save milliseconds. Their algorithms scan global markets non-stop. If gold is 1 cent cheaper in New York than Mumbai, the bot buys New York and sells Mumbai. Risk-free profit. It happens millions of times a day. So ask yourself this. If there's a $283 difference, what should happen? Every bot on earth should be piling in. Every bank, hedge fund, and algorithm should be backing up the truck. They should buy New York gold and sell Mumbai gold until the prices snap back together. The spread should close in seconds. But it hasn't. It's been open for 6 hours. It's just sitting there. Why is nobody picking up a $283 bill lying on the sidewalk? There's only one answer. Because you can't move the metal. Arbitrage has 2 steps. Step 1. Buy the cheap paper contract in New York. Step 2. Take delivery of the physical bar and sell it in Mumbai. The bots are attempting step 1. They are slamming into a wall at step 2. Either the computers know, or the risk managers controlling them know, that if they buy the New York contract, the gold won't be delivered. They know technical issues means insolvency. If you buy at $5,200 and are forced into cash settlement because the metal doesn't exist, the trade collapses. You're left holding paper while Mumbai keeps ripping higher. So the kill switch was pulled. Liquidity providers shut the bots down. They looked at the risk of non-delivery and decided it was infinite. That means arbitrage is dead. And when arbitrage dies, the global market dies with it. We no longer have one gold price. We have a New York price that's fictional, and a Mumbai price that's real. The U.S. market has become an island. Like a store advertising $10 televisions with empty shelves. The price looks cheap, but there's nothing to buy. The price is a ghost. And this isn't just gold. Look at silver. The spread between London spot silver and physical silver in Hong Kong has exploded to $13. $13. That's more than 10%. Normally, that spread is 10 cents. This tells us the metal is trapped. Silver in Hong Kong is being hoarded behind a wall. It cannot leave. If you have silver in London, you can't get it to Hong Kong fast enough. If you have silver in Hong Kong, you're not selling to London because you know the price is fake. The flow has stopped. Velocity has gone to zero. This is the signal of a systemic seizure, the financial equivalent of a heart attack. Liquidity isn't reaching the extremities, the exchanges. And when the blood stops flowing, tissue dies. We are watching the death of paper pricing in real time. That $283 gap is the insolvency premium. It's the market charging you for the risk that the U.S. financial system is broken. So why now? Why did arbitrage break today of all days? Why is metal trapped in Hong Kong? This isn't random. This isn't market psychology. This is legal warfare. And to understand it, we need to look at what changed. This is the excuse Asian banks are using to stop the metal from moving. We need to talk about Hong Kong. And we need to talk about a law that quietly went into effect on January 1st. Because the CME glitch is only half the story. To understand why arbitrage is dead, why the $283 spread refuses to close, you have to look at the other side of the bridge. While Chicago is dark due to technical issues, Hong Kong has quietly locked the doors. This weekend, right in the middle of a global liquidity crisis, major bullion banks in Hong Kong suddenly decided it was time for emergency system upgrades. Traders across Asia are reporting the same thing. HSBC Hong Kong and several other custodial vaults have effectively frozen operations. You try to withdraw physical silver. You can't. You try to allocate gold for export to London. Status, pending. The official explanation? Emergency cybersecurity maintenance. Compliance updates. It sounds boring. Routine. It is not. This isn't maintenance. It's a siege. To understand why, you need to know about a piece of legislation almost no one outside Asia paid attention to. The Protection of Critical Infrastructure Ordinance. It came fully into force in Hong Kong on January 1, 2026. This law gives authorities sweeping powers to seize control of, suspend, or freeze any system deemed critical infrastructure during a cybersecurity threat. And critical infrastructure includes financial clearing systems, settlement layers, and precious metal vaults. Now connect the dots. 1. A cyber incident, allegedly tied to Salt Typhoon, disrupts U.S. financial reporting. The CME goes dark. 2. Hong Kong authorities declare elevated cyber risk due to global instability. 3. They invoke the ordinance. They tell the banks, lock it down. No digital transfers. No physical withdrawals. No metal leaving the vaults. We need to audit the systems. It's the perfect legal cover. They aren't defaulting. They aren't admitting shortages. That would trigger panic. Instead, they're saying they're protecting the system. Just a temporary pause. Just a few days. Just checking the code. It's brilliant. It stops the bleeding without admitting there's blood on the floor. It allows China to effectively hoard every ounce of silver currently sitting in Hong Kong warehouses. Metal can check in. It cannot check out. Hong Kong has become a roach motel for precious metals. This is why the silver spread has blown out to $13. The market knows the metal is trapped behind a digital iron curtain. London is screaming for silver. Buyers are willing to pay a premium. But vault managers in Hong Kong point to a screen that says, System Lockdown, and shrug. Sorry. Government orders. Cyber scan in progress. Meanwhile, ownership is quietly changing. Metal is being retitled. Shifted from Western custody into Eastern strategic reserves. All while the lights are off. The timing isn't coincidence. U.S. reporting goes dark the same weekend Hong Kong locks the gates. This is a coordinated pincer move. The West hides the emptiness of its vaults. The East locks the doors on its hoard. And caught in the middle is the global supply chain, now suffocating. No flow. No liquidity. No release valve. We have just crossed the line. From a just-in-time metals market to a just-in-case hoarding regime. And once that shift happens, it doesn't reverse quietly. Overnight, the market shifted from a just-in-time system to a just-in-case hoarding system. And think about Monday morning. If you're a short seller, if you're a hedge fund that bet against silver, you're sweating bullets. To close your position, you need metal. But where do you get it? Not from the CME. The data is gone. Not from Hong Kong. The vaults are locked. You're trapped in a burning building with no exits. Pressure is building in the pipes. And since the metal cannot move to equalize the price, the only thing that can move is the paper price. The price on the screen has to go vertical. The asset is now unobtainable. We are staring at a potential force majeure event. The legal term for act of God. It's the clause that says if unforeseen circumstances prevent delivery, like a cyber attack, the exchange doesn't have to deliver the metal. They can pay cash instead. But at what price? Do they pay the fake New York price of $5,200? Or the real Mumbai price of $5,483? The fight over that settlement price will be one of the bloodiest legal battles in financial history. And it begins the moment the bells ring on Monday. We have a $283 spread, a broken reporting system, locked vaults in Asia, and a market that is waking up to the fact that the hack wasn't an accident, it was the start of a reset. So what happens when electronic markets open Sunday night? When algorithms realize liquidity is zero? We need to understand the physics of a block market. Normally, pressure is released gradually. Prices drift. Arbitrageurs sell. The market breathes. But right now, the valve is welded shut. $283 gold spread. $13 silver spread. Broken ledger in Chicago. Locked vaults in Hong Kong. No mechanism remains to equalize the pressure. When the market opens, the price cannot drift. It must teleport. My prediction for Sunday night is simple and terrifying. Silver could gap $20 in the first 10 minutes of trading. Not 20 cents. $20. Why? The first trades won't be speculative. They'll be panic coverage. Imagine you're a short seller. A mid-sized hedge fund short 500 contracts of silver. You went home Friday feeling smart. The price crashed to 90. Over the weekend, you see the CME data vanish. Hong Kong locks the vaults. The spread blows out. You realize you're short an asset that literally doesn't exist in the available float. If you don't cover immediately, you may be forced to deliver physical metal that cannot be bought at any price. The bell rings. You hit buy at market. You don't care about price. You just want out. And guess what? Everyone else is doing the exact same thing at the exact same time. And who is selling? Nobody. Arbitrage bots, the usual sellers, have been turned off. Liquidity providers are gone. There is no break. The market is about to explode. The sell side is gone. Miners are holding back because they smell blood. Dealers are under maintenance. You have a wall of buy orders hitting a vacuum of sell orders. The price has to jump to a level where someone is finally willing to sell. In a broken market, that level could be $120, $140, or higher. We are about to see a vertical green line on the chart that looks like a glitch. But it will be the most honest price discovery in 50 years. And yet, a darker possibility looms. Every commodities trader fears this phrase more than death: force majeure. If the CME cannot reconcile the books, if the Salt Typhoon hack has corrupted ownership records, they have a nuclear option. They can suspend trading. They can force all contract holders to settle for cash. We're sorry. We cannot give you the metal. Here's a check for Friday's closing price. They could try to pay $90 for silver trading at $130 in China. The ultimate rug pull. A default without calling it a default. If that happens Monday, don't celebrate the check. That check is a confession. A confession that the paper market has failed. That your contract was never a claim on metal. It was a claim on a promise, and that promise has been broken. And if everyone takes cash, they run to the physical market. But the physical market is empty. Then reality detaches from the screen. CME shows $90. You can't buy an ounce for less than $200. A bifurcated market. Two separate realities. This chaos isn't hypothetical. It is the inevitable result of the hack. Whether the hack was real or a false flag no longer matters. Trust is shattered. The bridge is burned. The global market is now a collection of warring islands. On Monday, paper island traders will try to escape to physical island, but the boats are gone. When you see headlines blaming volatility on cyber instability, translate it, the run has started. Shorts are trapped. Prices are searching for a new equilibrium. The $283 spread won't close gradually. It will close by the U.S. price exploding to reality, or the U.S. market ceases to function entirely. We have examined the dark data, the impossible spreads, the Hong Kong lockdown, the looming Monday chaos. What do you do? How do you survive a cyber financial war? You don't fight it with code. You fight it with atoms. Here's the verdict. We've stared into the abyss of the dark data. We've analyzed the $283 spread that defies the laws of math. We've seen the digital iron curtain descend over Hong Kong. We have prepared for the violent repricing that will hit when the sun rises Monday. But here's the truth for the individual investor. In modern finance, a cyber attack is the ultimate get-out-of-jail-free card for a bankrupt system. If a bank runs out of money, it declares bankruptcy. It's messy. It's public. People go to jail. If a bank or an exchange gets hacked when a critical infrastructure event is attributed to a foreign adversary like Salt Typhoon, suddenly the system isn't incompetent. It's a victim. Suddenly, freezing your withdrawals isn't a default. It's a safety measure. We're sorry, valued customer. We have the money. We promise. We just can't let you access it right now. We need to scrub the servers for malware. A week. A month. A year. This is what we are seeing today. The technical issues at the CME? Not a glitch. They are a shield. The maintenance in Hong Kong? Not an update. It is a lock. The narrative of a cyber war is being used to implement capital controls without passing a single law. They are freezing the exits because the theater is on fire, and they don't have enough fire extinguishers. That $283 gold spread? That's the smoke billowing out from under the door. If you are holding paper silver, an ETF, an unallocated pool, or a futures contract, you are in the danger zone. You are holding a claim ticket for a code check that is just burned down. When force majeure hits, when the system finally admits the metal isn't there, that ticket will be worthless. Best case? They pay cash, rapidly losing value, while the real metal trades at a premium you can't touch. The lesson this weekend is brutal, but simple. If you can't hold it, you don't own it. Any counterparty between you and your wealth is now a point of failure. The hack proved it. Digital ledgers can be erased. They can be manipulated. They can be turned off. But you cannot hack a silver coin. You cannot erase a gold bar with code. You cannot turn off the buy button on a bar sitting in your safe. This is why the spread exists. The market is pricing in counterparty risk. An ounce of gold in your hand in Mumbai is worth $283 more than a promise of gold in New York. The market is screaming, get out of the system. Convert your digital illusions into physical reality before the cyber lockdown becomes permanent. We are entering systemic partition. The West is going dark. The East is locking down. Liquidity will vanish on Monday. The price will find the truth. And the truth is expensive. There isn't enough metal to cover the paper promises. The hack didn't create the shortage, it revealed it. So do not be distracted by headlines about salt typhoon. Do not get caught in the technical jargon. Focus on the signal. The vault is empty. The exits are closing. The only safe harbor is the one you build yourself. This is John A.G. The data is dark. The spread is real. Get your metal out.